Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 190. But before we get into it, Stuart will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decision regarding topics mentioned on the show. There's a full disclaimer at the end.
Right, thank you, Stuart. Before we get going, a bit of housekeeping. I'm afraid that Richard is having a double knee operation and can't be with us today, so Stuart is subbing in. Thank you very much, Stuart. And I am very happy to report that I'm going off hiking in the Dolomites next week. So the next weekly will be week after next, but sometime not on Monday because I'll have to catch up. Anyway, the news. So once again, we go away for a couple of weeks and everything changes. This time, Israel has attacked Iran and then the US has joined in. So the situation currently appears to be that the US on Saturday night bombed 3 Iranian underground nuclear development sites, and they are claiming total success. We don't know whether that is true or not, but we are awaiting the Iranian response. So far, Iran has not attacked energy infrastructure around the Gulf or closed the Straits of Hormuz. So oil prices are up, but not catastrophically so. We'll take you through some charts later. Israel has so far attacked Iranian oil infrastructure that supplies the domestic market, but they've been careful not to attack infrastructure that supplies international markets. Gold has also risen. Elsewhere, Germany announced 500 billion of infrastructure investment over the next 12 years. The UK announced 750 billion of infrastructure investment over the next 10 years. Japan kept rate unchanged at 0.5%, but slowed the rate at which it is reducing its government bond purchases. So it's still buying government bonds. Trump has stated that he intends to set unilateral tariffs for countries with which the US has not signed trade deals on the 9th of July. And he has separately tweeted, and I don't know how true this is going to prove, but that he has done a deal with China, subject to President Xi's approval, which would set US tariffs on China at 55%, Chinese tariffs on US imports at 10%. China would continue to supply the US with rare earth metals. Now, if that proves to be true, that will mean a huge increase on tariffs for Chinese imports into the US with inflationary consequences. Economic news, well, US inflation came in soft at 2.4%, but everyone is forecasting that despite US inflation being soft currently, it will rise in the coming months. Goldman Sachs is forecasting a peak of 3.4% in September. So they're forecasting inflation to rise quite sharply in the coming months. The Fed also warned of risks to both ends of its mandate, i.e. higher unemployment and higher inflation, i.e. stagflation. The Bank of England also kept rates unchanged, but there was a bit of a dovish surprise in the form of 3 members of the MPC voting for a cut. And according to the FT, the expectations are now for an August cut, so cut next meeting, despite UK inflation remaining elevated. Switzerland cut rates by 25 basis points to 0% again. And will they cut further and return to negative interest rates? For much of the past decade, Swiss interest rates were negative. So this is Swiss interest rates for a long period post the financial crisis. They were negative. They've got back to zero after a round trip to 1.75%. The Fed has kept interest rates stable between 4.25 and 4.5%, but they're not only Donald Trump, but also some of the other Fed governors are now talking publicly about a cut when they next meet. The Bank of England kept interest rates changed at 4.25%. Bank of England next meets in August. When you step back and look at the bigger picture of global policy rates, they are clearly down. So the US and the UK have paused, but elsewhere in the world, central banks have continued to cut. And this is the dilemma facing the Fed. GDP growth forecasts are falling now 1.4%. That is very weak growth for the US by its own standards. Unemployment is rising, inflation is rising. Fed Governor Waller says that the bank should cut rates as early as its next meeting in July. Now, the war in the Middle East has so far not had catastrophic effects on the oil market, but it has had some effects. So oil prices have risen, and somebody, either the Israelis or the Iranians, have been jamming GPS signals, and that has caused two tankers, the Front Eagle and the Adolin, to collide in the Straits of Hormuz. Marsh McClellan, the world's largest maritime insurance broker, have warned that insurance rates for vessels travelling through the Gates of Hormuz have risen by at least 50%. So that will be inflationary and bad for the world economy. This is as of today, and prediction markets are putting over a 50% chance that Iran will attempt to close the Straits of Hormuz. Of course, they've never actually successfully done it. If they were to do that, then there is a lot of oil that goes through the Straits of Hormuz. 15 million barrels a day are produced in the region surrounding it, and about a third of the world's oil supply goes through the straits. As a result, oil prices are back towards $80. They've since come down a little bit. I think Brent, as of this evening, is about 77, but that is a big rise over the past month, about 20% rise. Now, by historic standards, when there's been a world crisis that results in restrictions in oil supply, then the oil price can go absolutely ballistic, and we are not there yet. The chart on the left shows the swings in the oil price when the supply is restricted. Reminder, oil demand is very price inelastic. People will continue to pay to use their car pretty much whatever the oil price is. But so far, flows through the Straits of Hormuz are unaffected. That could all change very quickly. Now, the primary market for Iranian crude is China, and they would suffer first, but of course, they would then need to buy their oil from elsewhere. The good news is that high oil prices actually only have a moderate impact on inflation. According to Schroders, a 10% rise in the oil price equates to only a 0.1% rise in US CPI. So that 20% rise in the oil price over the past month should result in only a 0.2% rise in US CPI. Now, a correction. Last week, we were talking about Ukraine's incredibly successful Operation Spiderweb, in which they took out some Russian jets parked on the ground using drones. Now, we stated that the Russian bombers were parked out in the open because of the START nuclear non-proliferation agreement, in which they need to be able to be seen by US satellites to verify the number of strategic bombers they had. Now, various people, but thank you in particular to our viewer, Janos Pack NE4312, who got in touch via YouTube to to correct us and say that Russia suspended its participation in the New START treaty as of February 2023. Now, the treaty remains in place, but they said they're not going to comply with it anymore, and therefore they're not really obliged to keep their bomb fleet out in the open. The reports I've read suggest they did so out of habit. And on to the UK spring statement, Stuart.
Right. Well, before we get into the details of this, I just wanted to make a broader point that if one looks at the UK productivity stats since the global financial crisis, if we had been able to maintain anything like the productivity trend of prior to the GFC, the economy would be about 30% bigger. Tax revenues, therefore, could be, say, 25, 30% bigger, and all the grief we're going through wouldn't be half as painful. So although there's a lot of commentary about the minutiae, I don't think we should miss the bigger picture, which is the lack of productivity in the economy and therefore the lack of revenues for the government.
Now, can I quickly come in there, Stuart? Now, we've done something on this before, and I think this is very tied up with changes to banking regulations in the UK, which have restricted bank lending to small businesses, i.e., they don't do it anymore. So, by imposing capital controls on UK domestic banks, they prioritize the divisions with the highest return on capital, which is credit cards, essentially. And lending to businesses is risky, lower return, so they don't do it. So you find that UK smaller businesses are starved of capital and basically can only grow by reinvesting profits, and that is obviously slow.
Well, that's a very interesting observation because there are many supposed causes of productivity weakness. But it would be horrible if that was true, that we've shot ourselves in the foot by over-regulating ourselves and causing this sort of bad spiral.
Hmm.
Right. Anyway, getting into some of the detail, there's been 113 billion increase in capital spending over the life of the Parliament, and defence is going to be the main beneficiary of that. Turning from capital spending to day-to-day spending, healthcare has again been the big winner, with the budget rising by 2.8% per annum in real terms. By contrast, the Foreign Office has been cut by about 7%. And the other headline of interest to many viewers and listeners will be the funding for small modular nuclear reactors. And I think, did Rolls-Royce get an actual contract announced the other day?
Yes.
Yeah.
Yes.
Okay, so going into more detail. So we're going to split this in between day-to-day spending and investment because Rachel Reeves's rules, she was splitting those two, and it's the day-to-day spending where she's coming up tight against her limits. So we can see in this nice graphic from the FT that it's again the NHS, it's health and social care that's taking the lion's share of percentage growth, but also of pounds. And this reminded me that I think it was a couple of years ago, there was the NHS workforce plan, which was announced. And if that's followed through, that will mean that 1 in 11 people in the workforce will be employed by the NHS.
Wow.
And I did a quick back of the envelope calculations comparing to some other large organizations. And so I went to the USSR and looked at the size of their military. That was 2 to 3% of the population. The railways, 2% of the population. So 9% of the workforce is perhaps 5 or 6% of the population. The NHS is just huge. I find it
Mhm.
impossible to think that it's manageable, but I don't think
Yeah.
any politician can grasp the nettle and say that the model is fundamentally broken. How can you manage something that big, that sprawling?
Mm.
Anyhow, back onto the actual data, what's happened. We can see there is paring back at the other end of the spectrum here, for instance, at the Home Office. The big question will be whether these are simply numbers in a spreadsheet to get debt and borrowing within the limits, or whether these can actually be kept to over the
Mm.
life of Parliament.
Yeah. I noticed that growth in the defence budget on day-to-day spending is actually really low.
Good point. Good observation. Yeah. Turning from day-to-day spending to investment, we do get the large change in defence, and we also transport excluding HS2, which has clearly been an extraordinary example of mismanagement and the state's inability to manage big infrastructure projects. So excluding HS2, transport has actually got quite a bit of an increase. If we believe these numbers are going to be stuck to, then the actual increases in day-to-day spending and investment spending are really, in the scheme of things, not that large. It's only a few percent real
Yes.
compared to previous governments, which have had on day-to-day spending up to 5% real, or investment spending sometimes into double digits. So one has to be skeptical about whether these spending plans can be actually stuck to over the next few years.
Well, the thing is, Stuart, what we're seeing in this chart is the growth of UK debt, which has expanded enormously over the last 20 years. And so this is the Tory government being fiscally irresponsible. And so they put us on this unsustainable path. And now the Labour government is stuck. With Rachel Reeves has increased the budget more than we expected, but actually nowhere near as much as previous Tory governments.
Well, if only we'd got something for it. Anyway, moving on. So picking up again on the NHS issue, the health department is expected to account for 60% of the increase in day-to-day spending. An aging and ill population is obviously going to be taking more and more resources, and that it's a sort of gradual asphyxiation.
Yes.
So putting that health and social care spending into a different metric, we can see the percent of total government spending, and it's gone from about a third to about a half over the
Yes.
past 20 years. It's just remorseless. Turning to defence, the big winner, I thought this was quite interesting, showing how much different countries are spending on defence as a percent of GDP. Because I'd always had the idea the UK wasn't doing too badly on this compared to most other NATO members. But actually, you can see that we're spending a reasonable amount, at about two and a quarter percent, something like that, with a
Mm,
target to get to 2.6%. But getting anywhere near the 5% that Trump claims he wants from Europe, I just can't see is going to happen.
no.
And obviously, we
Well,
saw Spain trying to sort of get their own carve out from this rule. So the likelihood of fragmentation and disintegration between NATO members seems reasonably high to me.
well, the US is nowhere near 5%. So, I think the 5% is just totally unrealistic.
Well, I think it's a classic Trumpism, isn't it? He asks for something outrageous because he hopes to push the solution somewhere in the direction of what he just asked for. Right. So we've got forecasts of the budget balance, but historically these forecasts have always been too optimistic because there's always underlying them a sort of mean reversion hope and expectation that productivity is going to return to its long-term trend. But if it doesn't, and it hasn't, then you're always going to fall short of what you're hoping to achieve on the revenue side.
I think the fundamental problem is whenever something bad happens, the government opens the fiscal taps. And in the good times, they spend any extra tax revenue above forecast. So you have this inherent asymmetry in the fiscal balance. It's always tilted towards increased spending.
And the IMF's view is similarly overly optimistic. The outturn is never as good, or never as returning to balance as forecast. So trying to sum that up, and Keith has already mentioned this, is the big picture that debt as a percent of GDP has risen hugely. 20 years ago, it was around 40% of GDP. Now it's over 100%. We can see the big hike after or during COVID, and it's not been reversed.
Yeah.
In terms of 1 year borrowing, this is comparing 24 to 5 with 25 to 6. So the forecast is that public sector borrowing will be down a bit this year. We will see. Turning to what got all the attention in the press, which is how close is she to her imposed rule for not having current spending not breaking her limit on current spending. She's got a very small buffer of about 10 billion, which is less in nominal terms than it used to be sort of 10, 15 years ago. So any fluctuation downwards in revenue, she could be in trouble, let alone having to spend something unexpected.
And I would also observe that, we've seen that throughout that period, none of the chancellors managed to get the UK towards fiscal balance, and they had much bigger headrooms.
Yeah.
So, whenever something unexpected comes along, it blows them off track, and she's got almost no headroom. So I would be skeptical that she's going to get anywhere near target.
Yeah. And hence why she is deeply unpopular. I mean, I wouldn't say that she was as bad as Kwarteng, but she's got popularity ratings the same level as he had. I mean, they boxed themselves in with all their pre-election promises on income tax and VAT, etc., so that they can't raise the normal taxes in the sense the most fair or straightforward ones. So they're constantly having to come up with different schemes and different pots and different tweaks to squeeze little bits in many places. So, in conclusion, our government spending is showing all the stresses to be expected from an aging population that is accustomed to high social spending. I would add the productivity issue here. I think it's just a
Yes.
noose that's gradually tightening on us, plus Keith's point about occasional one-offs. The healthcare budget is relentlessly upwards and is now half of all spending. So, in order to meet her fiscal rules, it's quite likely she's going to have to raise taxes in October. We're already seeing taxes as a percent of GDP as being at unprecedented levels. Future governments will find it increasingly difficult to balance the books because welfare spending just keeps on and on rising. And additionally, interest payments on the ever-rising debt will also add to the asphyxiation.
Yes. And that all that is a good recipe for poor economic growth because you are destroying incentives. The government is a low productivity sector and it's relentlessly rising. So when you're talking about productivity growth, Stuart, putting more and more resources into the government is self-defeating if you want economic growth.
Yeah, it's very bleak and it's difficult to see a way out.
And on that cheery note, on to the markets data. And once again, we're going to be leading with markets data. At some stage, the economic data will become more relevant. But right now, there's so much going on in the world. The markets are swinging with whatever Trump does. And over the past couple of weeks, the US and its ally Israel have attacked Iran, adding to uncertainty around the world. So generally, it's been a poor couple of weeks for equities. The FTSE All World was down minus 0.8%, Stocks Europe down 3.4%. Everywhere is still up on the year, though interestingly, the Russell 2000, i.e., the great mass of US equities which are largely exposed to the US domestic market, they're down on the year. So that implies actually underlying the US economy is not that strong. Bitcoin had a bad couple of weeks, down 4.7%, still up 8.8% on the year. The dollar has staged a little bit of recovery, but is still sterling is up 7.7% on the year versus the dollar, and the euro is up 11.5%. The dollar index is down 9%. So going through some charts, this is the All World Index. Actually not been hit too badly following the Israeli and US attacks on Iran, adding to a great deal of uncertainty. This is the All Share, and having risen very smoothly since its lows in March, it now seems to have peaked for a bit. The Euro Stocks is down over the past couple of weeks. S&P 500 now up 1.6% on the year, has pretty much regained its earlier highs. Notable how little they've been affected by geopolitical turmoil. This is the Nasdaq, Russell 2000. That is nowhere near its highs of last year. Suggests that domestic US companies are not doing so great. Hang Seng actually doing okay. Had that huge rise following DeepSeek and has held on to the gains. topics going nowhere. Bitcoin not proving a safe haven, actually. Sterling, now is a better time to visit the US, should you feel so inclined. Euro continuing to climb versus the US, which is slightly surprising given the softness of the Eurozone economy, which implies the ECB is going to be still cutting rates. Dollar index down 9% on the year. VIX going nowhere despite the tensions in the Middle East. I mean, it's amazing how small the rise in VIX has been. Investors do not think Iran is going to really disrupt the world economy. The Buffett indicator, which is US market cap relative to GDP, is 2 standard deviations above its historic trend and has breached, but briefly breached, 200%.
Keith, I do agree the US market is very highly priced, but this is a bit of a weird indicator these days because
It is,
US
yeah.
stock market value, I mean, all these tech companies have got numerous revenue sources all over the world. So comparing it to US GDP is a little bit, I mean, it might have been fine in the 60s,
Yeah,
70s, but I would rather use something like, the Schiller PE ratio to get a sense of the temperature of the market.
I agree. But, it's when you just, it's crude, but I think it gives you an idea of, the relative valuation of the market. I mean, if you buy it when it's below 1 standard deviation, that would be great.
Yeah.
Sadly, selling it above 1 standard deviation has not proved a very good strategy recently. And the US dividend yield has fallen to 1.26%, which is actually, again, on Stuart's point, slightly misleading because they do lots of buybacks, but just on the dividend yield, that's really low. Um, and the US investment position is really negative. So when you see Germany has a net positive international investment position, i.e., it owns foreign stocks and bonds and gets positive cash flows from that, so dividends and interest from its foreign investments. The US has a massive negative investment position, which means its companies and the government are paying out interest to foreign holders of the debt. Now, if the continued decline in the dollar means that the US were to lose attractiveness and they were to start selling, then you could see the dollar could fall much further. AI stocks they took a bit of a battering earlier in the year, but they've since regained most of that. That is a big swing.
In fact, I happened to see the price of the ARK ETF earlier today. That's jumped from $40 to 70. It's actually had quite a bounce.
Yeah.
I'm not touching it.
Yes, exactly. And now this is Hussman Strategic Advisors. And their model, which shows the valuation of the S&P 500, shows that it's close to the most overvalued it's been in history. And they claim that there's a good correlation between the 10-year future returns on the S&P 500 and their valuation model. So, given that they think the S&P 500 is vastly overvalued, they are forecasting that the future returns of the S&P 500 in the next 10 years will be around -6% per annum. You heard it here first. And finally, Bitcoin. So Bitcoin, like all bubbles, and frankly, I still fail to see what you need Bitcoin for. It needs constant fuel, and here is Michael Saylor, who's basically turned his company into a Bitcoin vehicle, suggesting that you should be turning your house into a savings account by which you borrow all the equity from it and buy Bitcoin.
It's phenomenal, isn't it? In a sense, I'm sort of flabbergastedly amazed and impressed with Saylor. The things he does to raise money for his company and buying Bitcoin is extraordinary. I think they issued a convertible bond, which normally you would expect to get some interest on and an option to buy the stock. I think they issued it at something like a 50% premium to the share price with a 0% coupon. So
Wow.
here's an instrument you can buy, which pays you nothing except the right to buy the stock at 50% more than it is today. And people lapped it up.
I give up, Stuart. This podcast is meant to be, rational. Anyway, so moving on to commodities and energy commodities. Well, first of all, a summary. So energy markets, unsurprisingly, very strong on fears of disruption to the oil market, feeding through to all other energy commodities. Industrial metals were rather mixed, generally down actually, but aluminium was up, nickel in particular was down. Precious metals continued to be safe havens, gold was strong. Rhodium, which has had a good run up, was gave some of that back. So taking you through some of the charts. Well, first of all, the commodities are up 17% since the start of 2024. So not bad actually. But if the world economy slows and tariffs cause a slowdown in manufacturing, then commodities would be expected to suffer. Commodities do well when the world economy is growing strongly. On to energy commodities. So Brent was up 16.4% over the past couple of weeks, now up 3.6% on the year. WTI up 14.9% over the past couple of weeks. Sadly, natural gas futures in Europe also joined in, up 11.2% since we last met, still down 20% on the year. British natural gas futures also up 12.9%, still down 23% on the year. US natural gas futures pretty flattish. Coal continuing its recovery, but still down 15% on the year. Uranium had a good couple of weeks, up 7.7% and now up 4% on the year. So this is Brent. Chart we showed you earlier had Brent spiking to 80. It's now settled down to about 77.5 as of this evening. If Iran were to even attempt to close the Straits of Hormuz, that would go a lot higher. This is WTI. Numbers specific to the oil market. Well, over the past couple of weeks, the US oil market has been pretty much in balance, neither a stock build or a draw. The US oil production has also been stable. The Baker Hughes rig count has continued to fall. If oil prices sustain current levels, then you'd assume that rigs will start to go back into the market. Now, hedge funds have been behind the rise in the oil price. They were previously underweight and they've been rushing to get overweight. But investors are very heavily underweight energy equities. If they were to change their mind, they have a lot of buying to do to get back to flat, which would drive a bull market in energy equities. But a reminder that OPEC are opening the taps, and over the course of the next year, they're going to be pushing a lot more crude onto markets which were, prior to the war in the Middle East, quite weak. Now, a lot of that oil needs to go through the Straits of Hormuz. So if Iran were to close the Straits of Hormuz, none of this would matter. Oil would go through the roof. So let's see what they do. They've never actually successfully done it. But the market is worried, hence the oil price is up. EU natural gas futures have run up with oil. That's bad for UK and European economic growth. UK natural gas futures. US, that's quite stable. We have something coming up on US natural gas. Coal continuing its recovery. And this is coal consumption since the Paris Climate Accord, which was in 2015. So the 5 years after the Paris Climate Accord, it looked like actually it had had an effect and global coal consumption had peaked. But then it ain't. Since then, China and India have built a lot of coal-fired power stations, and actually, there's been substantial increase in coal burning. Reduced consumption in the West has been more than offset by increased consumption in India and China, sadly. So coal is very much still part of the global energy mix. And if you look at the increase in Chinese electricity generation over the past 5 years, between 2021 and 2023, then you see is actually they have invested a lot in renewables, but they still needed to turn to coal to meet the increase in electricity demand. So hence, coal is the marginal electricity generation fuel in China and still has a place.
I was interested to see that there was nothing about gas there. Presumably, they don't want to be dependent on imports, so they'd rather dig their own coal.
Well, that's coal. That's an imported natural gas, Stuart, at the bottom, other
Yeah,
fossil.
so not much when the rest of the world is,
Yeah.
going from coal to gas.
Well, the thing is that natural gas, it's difficult to actually move it unless you've got the infrastructure. So you can imagine that on the coast, they can import LNG to the cities there, but to get it into the hinterland, 500, 1,000 miles, I mean, it's just impossible. So hence you're going to be using the local coal supplies. Uranium, that's a jump. Um, it's like they bomb Iran, who presumably is a consumer of uranium, and uranium prices go up. Now, but the reason for that is that Trump administration has promised to quadruple nuclear power by 2050. And this is US nuclear power. And look, it's has gone nowhere since 1990s. If well, Trump actually doesn't appear to care about climate change at all, but nuclear power would have the effect of reducing the US's reliance on coal and natural gas, which is a good thing. On to industrial metals, Stuart.
Right. Well, reasonably quiet week, frankly, here looking down the column there. All the big moves have sort of happened earlier in the year with cobalt up 37%, copper up 21%. Obviously all measured in dollars. Well, the thing
Yes.
that really struck me was lithium. It was a couple of years ago. It was going to be in short supply, and everybody was urged to sort of get what little lithium exposure they could. But as ever, a little knowledge is a dangerous thing when it comes to commodities, and it's off 20% this year.
Well, we back when it was in a huge bubble, Stuart, we did talk about how lithium, there was not a lack of lithium in the world. We just hadn't gone looking for it. And then, some of the good news sections we had serially were when we found absolutely enormous supplies of it. So in Pakistan, they found an absolutely enormous resource. And then they discovered that there's some extinct volcano in Arizona, which has 4 times the world's current reserves. So, the moment you start looking for it, there's actually large amounts of it. Hence, the price is down.
So aluminium, been having a good couple of months. Cobalt, well, it's very rarely traded, isn't it? There's not too much change in that price. Copper, more interesting, sort of flat, I guess, but it had a big weakness in April, didn't it? And has bounced back since then.
Yeah, but bear in mind this is priced in dollars, and the dollar has
Mhm.
continually fallen over this period.
True.
So on world markets, I would say it's going nowhere.
Right. There's copper and there's copper. There's the LME copper price and there's the COMEX copper price. And fears of import tariffs have led people to import copper ahead of such a possible tariff, and therefore the price on COMEX has been supported. COMEX is stockpiling its copper. My goodness, that's gone from what, almost
Yeah.
nothing to 150,000 tons. Wow.
So they're worried about tariffs. Trump has put big tariffs, 50% tariffs on aluminium and steel. So, they're trying to stockpile copper in case he sticks tariffs on copper as well.
Mm. But in China, there's a glut of smelter capacity. So the smelters are now having to will naturally now pay to get the concentrate, which they are then going to refine. It's sort of bizarre economics, but that's, I guess, how some
Yeah.
planned economy can end up producing.
Well, to me, this actually says a lot about the Chinese economy. So what they've done, this is just the dangers of command economy. So they've put a load of investment into Chinese smelters, and actually, there's now too much smelter capacity, so none of them are profitable. And the fee they're charging to convert copper concentrate to copper is negative. So, I mean, by definition, they're losing vast amounts of money.
Iron ore, oh, it's been dribbling off all year, hasn't it?
Yeah, again, China related,
Yeah.
no demand.
Lithium, oh, we've just covered this. Yep, weak. Neodymium going nowhere really.
Yeah, this is the price in China, of course.
Uh,
And so depends whether they do actually continue to allow rare earth exports. Because the price we're concerned about is the price in London or in New York.
Nickel, well, again, just generally weak, coming off a little bit. And yes, again, the dollar remark is opposite here.
Yeah, wall of copper coming out of Indonesia.
Tin showing a little bit more life very recently, but nothing major. Zinc similarly deflated. Getting now to precious metals. Well, another decent week for gold, up 2%, taking the year-to-date a change to 29%.
Yeah,
Silver
amazing.
close behind now, up 25% for the year. Um, Rhodium was weak this week. Any idea of the story there?
No, I just think it's had a very good run up,
Mm.
giving some back. Very volatile, small market.
So this is the gold chart. Every time you look at the chart, you think, my goodness, that's high. But then every time you look at global debt levels and budget deficits, you think, oh, I'd rather hold some gold. And I guess central banks
Mm,
are thinking the same because of sanctions risks. Yes, the rise in the gold price has meant that, or if you value central banks' reserves at market prices,
mm.
gold is now the second largest store of value for central banks. So the dollar is at 46%, gold is at 20%, the euro at 16%, and everything else at 18%. So here's the silver price. We can see that jump quite recently, trying to catch up with gold. If you believe that there should be a stable gold to silver ratio over time, then silver's the thing to buy at the moment. I'm not sure I believe that that is the case over time because of the different supply dynamics for silver, but it's definitely true that silver is very lowly priced compared to gold at the moment.
Yeah, I'm with you, Stuart. I don't see any reason why there should be any ratio between the two.
Call volume on silver is enormous, so people are hedging themselves or speculating. That's a
Mm.
huge change, isn't it? Platinum, my goodness, that's jumped enormously, hasn't it? From under $1,000 an ounce to almost 1,300. Rhodium, yeah, well, no real information. Palladium also reasonably strong.
Yeah, that looks like it's having a bit of a run actually, but it's done this before and then fallen back.
Mm.
Thanks, Stuart. On to rates. So this is UK yield curve. Still, again, the market is charging a big premium to lend to the UK for any period above 5 years, basically. Lack of confidence in the UK. The US yield curve is much more reasonable. Now, this is the fundamental problem. You see this, so this is a chart of global sovereign bond issuance, and you see there's a clear break of the pandemic. So governments lost control of their finances during the pandemic and have not got them back under control. The US being the poster child for this effect and fiscal irresponsibility. The size of the US deficit now means that the US government uh, issues roughly half of all US debt issuance. That is crowding out. So the lack of confidence and the huge US fiscal deficit means that elevated US rates, your government rates, feed through to elevated US private sector rates. So that's bad for the whole private sector, corporate sector. And this is a summary of the most recent changes in global policy rates, and you'll see the vast majority of them are down. Only Brazil, Turkey, and Argentina have been raising rates recently. Developed markets, banks, central banks are cutting rates. But the rise in bond yields, as was discussed before, is nothing to do with inflation expectations. Inflation expectations are stable. It's to do with markets becoming concerned about the size of government debts and their long-term sustainability. So if you look at the changes in bond yields since the start of the year, actually short-term rates, 1 year, 5 year, they've fallen in the US, the UK, France, Italy, but they've risen at the 30 year. So this obviously cost me quite a lot of money, but markets are concerned about fiscal sustainability, and higher debt and higher interest rates of the 30 year and 10 year are equating to higher debt servicing costs. Bad for the fiscal balance in all developed markets, apart from Switzerland, which of course has now cut rates back to zero and is likely to be negative quite soon, if you ask me. So this is the UK 2 year, actually fallen recently. And you'll note that in the last MPC meeting, 3 members were voting for a cut at the next meeting in July. 10 year, actually, towards its recent lows, but frankly, it's always bounced off this, and I will not be buying duration until we get past the budget. Same for the 30 year. This is the US 10 year. The recent comments from other Fed governors talking about how the Fed should start cutting rates has led to a bit of a rally in US government bonds over the last couple of days. It's a German Bund yield, flattish towards its lows. Same with France, Italy. And that is despite Italian government debt reaching 3 trillion euros for the first time. And when you look at that chart, that is not reassuring. That does not, the thing is, so Italian 10 year is at 3.5. The UK 10 year is at 4.5. Italy has a higher budget deficit and is more indebted. Explain that to me. This is Greece. And moving on to this week's economic data, a quick summary. So UK, stagflation, EU, stagnation. US, actually the economy is slowing down a bit, but inflation's picking up. So it still has decent enough growth, but it's heading towards stagflation. China, no inflation, growth slowing, stagnation. Stuart, the UK.
Right, so inflation month on month, well, we had that horrible number in April, didn't we? 1.2%, down to 0.2% in May, but still sort of grim.
Well, actually, that's quite reassuring. It says that the April number was largely driven by one-offs.
But I was hoping for a negative number, some sort of unwind, but that didn't come through. Converting that to year on year, well, we've had a bit of a rise, haven't we, over the past 6 months, where we're now up to 3.4%.
Yeah, and the Bank of England is forecasting it to peak at 3.7% not in September. So, not reassuring.
The core inflation month on month fell from 1.4% in April to 0.2% in May. Converting that to a core inflation year over year, well, we're still in the mid threes, aren't we?
We are. And, the Bank of England is talking about cutting rates. I just think it's way too soon.
RPI month on month was 0.2, which was actually below expectations of 0.6. But year on year, it was at 4.3%, which was in line with expectations. So something odd, I think, about some of the numbers there. But
Yes, I don't believe the expectations, frankly.
yeah. Some bit of good news is service sector inflation fell to 4.7%. So high, but not as bad as previously.
Yeah, still disastrous.
Food inflation was at 4.2%. So that's consistent with the recent rise in soft commodities being passed through to consumers. But there's more of that to come, as we can see in the chart here, the green bars. If you advance the soft commodities inflation by 12 months, there's some more pressures to come through.
Yep,
52% of the inflation components were rising at a rate of greater than 3%. So that's rather entrenched, isn't it?
it is. Yeah. And so I just don't think there's any reason for the Bank of England to be cutting rates. They're assuming that softness in the labour market will feed through to low inflation. But, we've been here before.
And this is the number which I know you've highlighted in previous podcasts, but I find it extraordinary. UK earnings growth is just so much higher than you would expect given growth and productivity. But here we are, 5.5%, sorry, 5.3% in April for earnings
Yeah.
growth, including bonuses.
So the IMF were talking about this, and it's all down to mandated wage increases by the government. It's all down to rises in the minimum wage and feeding through to wage inflation further up the wage deciles. So if the government were to get out of the labour market, then wage inflation should come down. Now, hopefully, this year, the public sector pay rises are 3.5%. So wage inflation will come down towards target eventually.
The number excluding bonuses is pretty much the same, really, still sort of mid 5%. Oh, right. Well, this is what you've just been talking about, isn't it? Public and private sector, both,
Too high.
yeah, mid fives again,
Yeah.
across the board, really.
Well, last year it was the public sector pay settlement was like something like 6.7%. It was really high, and this year it's down to the 3.5%.
Average weekly earnings for regular pay by sector is shown here. So we can see, what's that? Wholesale, retailing, hotels and restaurants. There's demand, there's pay increases there.
Yeah, this is the fundamental problem. You had an increase in the minimum wage of, from memory, 12% in April. So of course, sectors that employ a lot of people who are low skilled on the middle minimum wage, they're experiencing very high wage inflation, plus national insurance, which they're attempting to pass on. So
Yes,
that's all
conversely,
very inflationary.
yeah, conversely, you can see presumably better paid people in finance and business services up only 3%.
Yeah. Returning to that, Stuart, you're absolutely dead right. So higher paid people in finance and business services, 3.2%. That is the sort of number you would expect to see given
Yeah.
the labour market dynamics.
So weak employment change, but still positive.
Yeah. And I don't believe this, frankly, because so we've had this again and again. So what they're saying is 3 month employment change, according to the Labour Force survey, over the past 3 months, 89,000 change in UK employment. But the unemployment rate is growing. And when you look at HMRC payrolls, if you sum up the change in payrolls over that period, so February, March, April, it was down 118,000. So, according to the Labour Force survey, we added 89,000. But actually, when you look at who's on payroll, it's down 118. UK statistics are a total mess, basically.
The claimant count. Oh goodness, this is not good news, is it? That's up 33,000. Um,
Yeah.
uh, and a little data error there for April, but the bigger picture to me would seem to be that there is, some emerging increase in unemployment, isn't there? We saw that in the unemployment rate, and we're seeing
Yes.
a version of it in the claimant count. GDP month on month, after some not too bad numbers, there was a kick in the guts, minus 0.3% in April. Converting that to year over year, GDP growth was 0.9% in April. I mean, it's just can't do anything with that. It's just too
Mm.
flat. Industrial production year over year, minus 0.3%. So it's another version of stagnation, isn't it?
Yeah,
Retail sales, goodness, May was a terrible number, minus
that's a terrible number.
2.7% month on month. So retail sales year on year, minus 1.3%. Construction output year on year was actually 3.3%. I think you've highlighted this in the past few, haven't you? That where is this construction output coming from?
Yeah,
Yeah.
but well, in London, you see a lot of flats going up that were, because there's such a long lag in these huge developments. So because construction that was started in COVID, is still going on.
Hmm.
One day, the cheap money will run out.
UK RICS house price balance has got worse. Well, obviously, we had a bit of a bump, didn't we, with the stamp duty reduction, and now that's gone out of the system. There's no momentum, no enthusiasm in the housing market.
Yeah, you're seeing that prime areas of London are doing very badly because of all the non-doms leaving.
Mm. Manufacturing PMI, actually not too bad, 47.7, a bit better than expectations, though still lower than 50. Services PMI a bit above 50. Not in itself a disastrous number, but I think the bigger picture is just this stagnation
Yeah,
accompanied by inflation.
yeah.
Composite PMI, therefore, roughly okay, just a bit above 50.
Yes, that's sort of stagnationary number though, isn't it? So going
Mm,
nowhere.
yeah. Balance of trade, haha. We all knew this was going to be a negative number. Minus 7 billion, though, was worse than expected. Consumer confidence, well, not muddling along, actually.
Yeah, not too bad actually.
PSBR, awful, as we know.
Yeah, but again, it missed, but it didn't miss as much as April. So that's kind of good news, I think.
I just think if you go back on that chart, I mean, just look at the numbers since COVID.
Yeah,
It's taken a step change down, hasn't it?
it
And
has. Yeah,
it's miserable.
yeah, it's out of control.
Oh, Richard isn't here for the economic surprise index. I'm surprised at that. Um, Relative to whatever expectations were. So they were beaten. Economic surprise was at plus 37.
Yeah.
Indeed, jobs postings keeps dribbling off. Nothing exciting or interesting or optimistic there. Right. Well, talking of non-DOMs, this I thought was very interesting data because it is data. It isn't just party political posturing. So this is a measure of UK company directors filing a new country of residence. And you can see
Mhm.
there was a little uptick when the Tories started talking about their changes to non-DOM registration and eligibility, but it's gone through the roof over the past few months.
Mm.
This, I think, is very interesting, very telling data that the people are moving.
Well, that's the thing. If you try and fleece the rich, the rich are, the properly rich are very mobile. They can simply leave the country. And so the tax change that has really upset the non-doms is that they've imposed inheritance tax on worldwide assets for non-doms. And they've failed to see why they should be giving the UK government 40% of their worldly wealth, and they're simply leaving the country.
Right, UK electricity prices and the green agenda. Well, nuclear is one possible solution, but guess what? We're not good at building them cheaply. So here is a comparison of build costs on recent projects in dollars per kilowatt. So Hinkley Point is way out there, followed by Sizewell C, then a US one called Vogtle, then so much cheaper at the other end of the spectrum with
Mm.
Korea and UAE. My understanding is that Korea, they've got a design and they keep on using it. They're not having to sort of come up with new designs and new regulations every time, that they're getting economies of scale by keep on using a particular design. And then, of course, you have a skilled workforce, you have experience. The UK is at the opposite end of the spectrum.
Absolutely right, Stuart. And when we've previously talked about France, they're exactly the same. So the first new reactor they built, incredibly expensive. Subsequent ones, they know how to do it. They're falling in price. Now, the trouble with us is we're only going to build, what, a couple? And so we're not going to have that experience, keep that experience, or have that economies of scale. These are charts from our Discord member Legion 852. Thank you very much. And he's talking about the rise in inflation. And you can see that when you go back to June 2024, housing and household services, i.e., that is energy bills, were minus 0.65%. And now, when we move forward in April, they were plus 1%. So, housing inflation has added 1.6% over that period to UK inflation. So much of the swing inflation is simply down to energy costs, not a big resurgence in inflation and other forms of inflation.
So UK summary, UK inflation was 0.2% month to month in May, which Keith regarded as reassuring. I was less pleased given that we'd had a terrible number in April. So CPI year on year 3.4%, core CPI 3.5%, making it difficult for interest rates to be cut. The labour market is slowing. Unemployment rate rose to 4.6%. The claimant count is rising. Industrial production is stagnant or falling. Retail sales fell 2.7% month on month in May, so no joy there either. And the PMIs indicated the economy was stagnating. So we'd like to be more positive, but really it's very difficult to be.
Yeah. So going back to when you said that making it difficult for the Bank of England to cut rates, I mean, the reality is, Stuart, they're talking about cutting rates. I mean, they, like the Fed, they sort of have a dual mandate issue in that inflation is much higher than target and forecast to rise over the next couple of months, but the labour market's slowing. And so, should they keep interest rates high because inflation's not on target, not heading towards target, or cut rates to support the economy? And the history of the UK is that if in doubt, you support the economy and support the social construct. So, hence we spend huge amounts on welfare spending, and we cut interest rates if there's any contradiction between fighting inflation or stimulating the economy and keeping people happy and in employment. And onto the EU, right, pushing through this quite quickly. So Q1 wage growth was good, i.e. 3.4% back towards pre-pandemic levels. The EU is beating inflation. Industrial production, well, that tariff effect of bringing orders forward had faded in April, and industrial production fell 2.4% month on month. Year on year, an anemic 0.8%. Construction production was very good, actually, like the UK, surprising 3% in April. And the construction PMIs have been relentlessly negative for the past 18 months. So that is very surprising. Economic sentiment bounced back as Trump has for now put EU tariffs of 50% on hold. I think they are still I think he's still threatening to impose like 50% tariffs in July unless they come to a deal. So watch this space. Further volatility ahead. Manufacturing PMI kind of stalled at 49.4, so still in contraction territory, but mildly in contraction. Services at 50, in line with expectations, up slightly from May, but that is stagnation, which meant the composite was at 50.2. So again, stagnation. Your EU consumer confidence is, well, they're never happy. They never get to zero, but that's a moderate misery, I think we can say. Balance of trade, not as high as it was, but still positive. The UK would love that. Economic surprise index at 29.5. So the EU continues to outperform very poor expectations. The Indeed job postings index for Germany indicates that the labour market and hence the economy in Germany is still declining despite all the announcements of government stimulus measures. In France, it's kind of been stagnant for a few months, actually, not deteriorating. So, EU summary wage growth slowed to 3.4% year on year in Q1, which means, which is consistent with Eurozone inflation coming back under control towards the 2% target. So, in summary, stagnation in Europe, actually. And if Trump is to go through with raising tariffs on the Eurozone, then the Eurozone economy is likely to be structurally weak, particularly given that Europe, and including the UK, have very high energy costs, which means that Eurozone industrial production is structurally weak. On to the US, Stuart.
Right, well, interest rates were not changed, but obviously we've discussed the pressures on the Fed there. CPI month on month, 0.1%, perfectly acceptable, which means the year-on-year rate is now 2.4%. So that would be slightly nudging the Fed towards cuts. Core CPI month on month, again, 0.1%, very comfortable. So year on year, 2.8%. So that is in contrast to the UK, where we saw that number picking up over the past 6 months or so. Goodness, this is a complex chart. What's going on here? Very good CPI in May, as we've just mentioned. No sign of tariffs impacting prices yet, and it was really shelter that was the largest contributor to inflation in May. But I think overall, it was a very good CPI report.
Yeah, so what the color you want to be concentrating on is the light blue, which is services excluding owner's equivalent, rent, healthcare, etc. And you'll see there's not much inflation. Yeah, so this was a really good
That had been
inflation report.
But owner's equivalent rent is now finally cooling, so it should be less of a factor in coming months. It's obviously a fairly smooth, slow-moving series, so that can be expected to be helpful over coming months. The annualized owner's equivalent rent is now back to pre-COVID levels, so the bulge has gone through the snake, as it were.
Exactly.
1 month annualized rental inflation is now down to much more acceptable levels, about 2.6%. Excluding shelter, 6 month annualized CPI is only at 1.7% now. So that's again, it's another version of the pressure on the Fed to cut.
Mm.
CPI by categories. Well, the most important one here, I think, was motor vehicle insurance, which still rose by another 0.7% month on month in May.
Yeah, so we still are getting this secular rise in insurance prices, which is driving inflation, keeping inflation higher than it otherwise would be.
Right. Alternative estimation methodology for the CPI. So the question here is the Trump administration cooking the books. Almost 30% of the CPI data in April was imputed rather than measured directly. My goodness. This is apparently because of job losses at the BLS, which reduced the sample size of its surveys. Well, that is an issue in the UK, but I think that's in the UK is more to do with incompetence. But here it seems to be to do with you just haven't got the resources. That's
Right, Doge. It's
scary.
Doge. This is Doge. This is the direct effect of all their cuts, reducing
Mm.
competence and the number of personnel in the US government.
Goldman Sachs are estimating that US inflation is going to peak at 3.4% next year. So if that were true, then that would clearly reduce the scope for interest rate cuts. Now, is this on the left their contributions to an increase in oh, this is the impact of tariffs,
Yes.
right? On auto parts, goodness, yes. They'll be imported from all over the place, won't they?
Yeah.
Um, Reciprocal tariffs excluding China, another big contributor. So, right, yeah. I mean, obviously, this has got to be work in progress as the tariffs will change week to week, but shows the extent of what's possible.
Yeah,
And
and
then
you
I guess
see
the issue is whether there's any sort of follow through to wage growth or whether this is a one-off.
precisely because the thing is, Stuart, when you look at that chart from Goldman Sachs, I mean, I can see that is quite concerning because the Fed Governor Waller is talking about cutting rates at their next meeting in July, but the inflation numbers are saying that inflation is going to keep on rising to peak at 3.5% mid next year. So is the Fed
Mm.
really going to be cutting rates? And the market's assuming they're going to be cutting two more times this year when inflation is heading relentlessly in the opposite direction. Either Goldman Sachs are wrong, or I can't see the Fed being able to cut as much as it would like.
US PPI year on year 2.6%. So again, converging on an acceptable number. Core PPI 3%, so slightly higher, but still not too bad. Retail sales month on month are beginning to show some weakness. Both April and May were negative, and May was minus 0.9%, a pretty chunky number. Well, May retail sales in more detail. It was weak headline, but the core spending apparently held firm. I wonder what counts as core in this.
Yeah, I think what we're saying here is that US consumers are avoiding big purchases. So I interpret this as meaning they're cutting down on housing renovations, i.e., business materials and autos. So, they're keeping spending on everyday items, but higher interest rates, they're maxed out on their credit cards, as we know. So they're cutting back on big expenditures.
Retail sales year over year in aggregate, 3.3%. So showing a little bit of losing a little bit of steam. Industrial production year over year, 0.6%, so not great. Michigan consumer sentiment fell very heavily during all the tariff talk. Has bounced back a bit, but it isn't back to the levels of last year. Consumer expectations, well, basically the same pattern. Current conditions are not very happy and not much of a bounce there. That's looking rather glum. 1 year inflation expectations, well, this wangs around quite a bit, doesn't it? 5.1% at the moment for what it's worth. 5 year expectations at 4.1%. Manufacturing PMI still holding okay, just above 50. Services PMI, again, a bit above 50, 53, not bad.
Yeah, but not strong either.
No, not as strong as it was. So the composite just under 53.
Yeah, I'm actually surprised by the manufacturing PMI because the impact of tariffs, I mean, you've just stuck up the input costs of a lot of US manufacturers because they mainly manufacturing in the US largely involves assembling components that are made elsewhere. So whose prices have all gone up. So I'm surprised it's as positive as it is.
Hmm, good point. Consumer inflation expectations have relapsed back to about 3.2%, not too bad. NFIB business confidence, well, it's sort of similar issue, isn't it, actually, that I'm surprised it's not more negative.
Yeah.
The Conference Board leading economic index, well, goodness, the leading index looks weak, whereas the coincident index looks reasonably strong. Is that the picture here?
Yeah, the leading index has been weak for a very long time, and
Mm.
as as we talked about, last couple of years, has totally failed to forecast a recession.
The stock market's propping up the US economy. Well, this is interesting, isn't it? Because of the sort of reflexive nature between the market and the economy in a very financialized economy like the US. So, these are components leading to the,
Yes.
yes, okay. So the economy is being predicted by the stock market, which is supposed to be predicting the economy.
Well, yeah. So, when you look at the components, I mean, the criticism you'd have of the conference board is it's very manufacturer led.
Hmm.
So, new orders index, building permits, etc.
So again, perhaps it worked in the 50s, 60s, 70s, but is not
Yes.
so appropriate.
Yeah.
The New York Fed Empire State Manufacturing Index, well, that's looking a little glum, isn't it? Not too happy, minus 16.
Yeah.
Another glum one is the NAHB Housing Market Index, which has fallen to 32, which looks to be pretty much on a par with the lowest levels over the past few decades.
Yeah. Now, this is interesting because we've been talking in recent episodes about how the US housing market does appear to be weakening. And when we've talked previously about what causes a recession, it is the construction and manufacturing sectors losing jobs, causing a cascade throughout the economy. Now, we haven't started yet in that the housing market and the construction market are weak, but that hasn't led through to losses in construction jobs yet. But given the weakness we're starting to see, you'd think that is only a question of time.
Well, added to which, you've got obviously all Trump's deportation program, and I'm assuming various construction workers are illegals, so you would imagine they're
Mm.
hiding.
Mm.
Building permits, there's a risk of seeing patterns here that don't necessarily exist, but to me, that begins to look like some weakness over the past few months.
Yep.
Housing starts similarly, though they held up surprisingly strongly, but perhaps the first signs of a broad weakness there. Initial jobless claims, again, it's really picked up over the past month, from the levels of around 220 to more like 240.
Yes.
Some cause for concern, and continuing jobless claims, I think we are seeing a trend there. That's pretty clear. So when people have lost jobs, they're not picking up a new job very quickly. They're continuing to claim unemployment benefit. Indeed, jobs postings, well, remorselessly down. Link Up is continuing to report rapidly declining job openings in the US. So that adds to the official numbers to give a picture of some emerging weakness. In terms of the forecasts, the nowcasts, the Dallas Fed weekly GDP estimate is still at 2%, which is okay. The Atlanta Fed, well, this one jumps around, I think, because of its treatment of imports, doesn't it?
Yeah.
But that's actually pretty positive at 3.4%, though that's down from an estimate of 3.8% last week. The New York Fed nowcast is though at only 1.9%, falling from 2.3%.
And this is the one we like the most because it appears to be the most stable. And that is showing, I'd say, over the course of the last couple of months, a distinct downwards trend.
Hmm.
Still okay. The numbers aren't disastrous, but it suggests the economy is weakening.
St. Louis are now cast at 1.5%. So again, one of the weaker estimates. Economic surprise index, well, noticeably negative, minus 24. So if you believe like there's a sort of stall speed aspect to economies, then there's emerging evidence that perhaps the stall is beginning. The fall in the dollar and the bond yields should mean that US economic growth would be supported. Uh, but I can't help but think that CEOs are going to be looking at the state of the world, state of tariffs, state of what's happening in the Middle East, and holding back, and that's bound to lead to
Mm.
a stalling. US trueflation 2.1%, up a bit on last week.
Yeah, and here you see, what Goldman Sachs is talking about. So tariffs lead through to rising inflation with a lag, and not really in the May numbers, but June.
Hmm. You and I keep talking about deficits, but we are not apparently representative. This is a measure of the issues that voters are concerned about in the US, and government and poor leadership is out there at 26%, but the federal budget is one of the lowest things that people are concerned about, just 3% of people. Tariff receipts, my goodness, yeah, we are seeing the impact, aren't we? Over 22 billion in May.
Yeah. Now this is actually a tax. So this is fiscal tightening actually, and mainly affects is a very regressive form of tax. And the poor tend to buy goods, the rich tend to buy services.
Wage growth for low-paid workers has dropped away, is now below average after a bit of a catch-up period.
Yeah. So this is a complete contrast to the UK. So, in the UK, you'd see the opposite because the government has been mandating higher wages for lower paid workers. In the US, where they're not interfering in the labour market, inflation is coming down.
According to Glassdoor, US employee confidence is at its lowest level since 2016. That has fallen off massively, hasn't it? Goodness.
Exactly. So employees are feeling insecure.
Hmm.
Talking earlier about weak retail sales and nobody wanting to buy, large items. Well, in order to buy a car, you have to be confident you're going to remain in a job.
Goldman's, after their inflation forecast, have done a GDP forecast, and they're expecting growth to slow to 1.25% annual rate in Q4, largely due to tariffs. Well, this is interesting. This is residential construction compared with employment. So we see in the black line the number of employees, which has been on an upwards trajectory, has not tailed off at all. Conversely, housing starts, which had tracked employee numbers reasonably well, housing starts have fallen quite dramatically, and yet the employment to build those houses has been upwards and upwards. So this looks like a sort of recipe for some delayed action unemployment.
Yeah, I just don't get it. I'm mystified. If anyone knows what the hell's going on, please can they enlighten me?
Right, yes. 70,000 people have signed up on the Trump $5 million gold card visa scheme. Now, this is just people signing up to express some interest. There's very little to it, but if they all followed through and gave the 5 million, that would be $350 billion.
Yeah, actually, that is a decent chunk. You know
Perhaps you saw today that Farage is also suggesting for 250 grand, non-doms can come back and they won't have to pay any tax for 20 years.
what?
Yes,
That's
yeah.
a bad deal.
So US summary, the Fed held rates, but it's warned that it's got risks to both sides of its mandate. So we've got the slowing labour market that would argue for cuts, but we've got rising inflation that argues to at least stay still. May CPI inflation came in at soft at 2.4%. Retail sales were weak. Industrial production was also weak. Housing market is slowing and jobless claims are rising. So the US, which has been the great supporter of the world economy, is showing some signs of slowing after tremendous resilience.
Thanks, Stuart. On to China briefly. So this is outstanding yuan loan growth, and it's continually slowing. So we know China has vast amounts of debt, and it has refrained from doing more debt-related stimulus, and loan growth is slowing. Money supply is also slowing. Industrial production came in below expectations, though it's still 5.8% year on year, if you can believe it. Fixed asset investment also slowing. Retail sales were surprising to the upside at 6.4% year on year. So finally, is that evidence that China is rotating towards more Western style of economic growth, i.e. led by consumers rather than mandated investment? Unemployment rate, 5%. This looks a highly managed chart to me. House prices still falling, but falling at a slower rate. In foreign investment into China still declining at 13.5% a year, and that is a bad number given that it's been negative for a few years now. And Chinese exports to the US, which is the pink line, have fallen quite sharply. That's almost down 40% year on year, but exports to the US elsewhere in the world have risen slightly. So total export growth continues to be positive, i.e. China has coped pretty well with the drop in exports to the US. The US likes to think it's global economic superpower and that everyone needs it. Well, not anymore. In summary, we think the Chinese economy remains weak and is undergoing a balance sheet recession. So on to one chart. Now, we showed you this chart last week, and this is Goldman Sachs' estimate of how the one big beautiful bill will affect US GDP. So they're pointing out that just like in the UK, the one big beautiful bill is all for fiscal responsibility later and fiscal irresponsibility early on. So it's stimulatory in the first 4 or 5 years, and then it's contractionary, i.e., when Trump has left office, somebody else has to deal with the a reduction in the US deficit and presumably a slowing economy. So it's very, very much I will be responsible later. What's that Pope? So it was St. Anselm,
From
wasn't it?
Augustine, who sort
Yeah.
of make me celibate, but not yet.
Yes, exactly. That's it. It's a story as old as time. Well, we also showed you this chart, which shows 22.2 billion tax receipts from the tariffs in May. Now, if continued at that rate, and obviously, frankly, Trump changes his mind about tariffs every 15 minutes, but if we were to continue getting 22.2 billion a month for 12 months, that equates to 266 billion or 0.9% of GDP. So, if we now look at the net effect of Trump's policies, including the tax receipts from tariffs, well, suddenly it looks less stimulatory. Actually, next year, it only mildly increases the deficit, and the same in 27. And then thereafter, you're seeing quite a big cut in the deficit. Now, I'm deeply skeptical that the spending cuts to Medicaid, etc., will happen. But the bottom line is that tariffs will largely offset the increases in spending that he's proposing. So the one big beautiful bill will not be as fiscally irresponsible as we supposed because of tariffs, if tariffs remain in place. So moving on, let's talk about the impact of new technology and Waymo. So Waymo have launched their driverless taxis in San Francisco, and the chart in the center here shows was that aquamarine blue at the bottom, the share of San Francisco taxi bookings for Waymo going from naught in August 2023 to over 25% now, overtaking Lyft. And the shares of Uber at the top, which dominates the market, falling, and Lyft also falling. So you would think, well, I would think, that that meant more competition, taxi price deflation. Actually, dead wrong. So it turns out Waymo is more expensive, and not just a little bit more expensive, a lot more expensive. So Waymo prices are at the bottom here. The average price for Waymo is a third more than for Uber, which in turn is more than for Lyft. And that is particularly true for short journeys. So for short journeys, Waymo's averaging $26.5 a kilometer rather than compared to 19 for Uber. And it surely doesn't help that Waymos are based on the Jaguar I-Pace, and the estimated cost of a Waymo, including all the technology, which uses LiDAR and other very expensive technologies, is around $200,000 per taxi. Now, so in the news this week, Elon Musk is attempting to launch his robo-taxi service, and that will just use cameras rather than LiDAR and the other expensive technologies that Waymo uses. So presumably, Elon Musk's robo-taxis will be substantially cheaper. But what's really interesting is that consumers in San Francisco are willing to pay a big premium to get a Waymo compared to traditional taxis. So that leads me through to the quiz of the week, Stuart.
Right, bring it on.
and this is a philosophical question. You are the Statistical Bureau in the US. Has Waymo increased or reduced San Francisco taxi prices? Okay. So the cost of Waymo is 30 to 40% higher. But
Okay.
it's a new service. So consumers are willing to pay up for the novelty of a Waymo and the fact that they're not sharing the cab with a taxi driver, so they feel more secure. So has the price of taxis has the inflation index for taxi prices in San Francisco gone up or down?
Well, I'm going to stick with the traditional answer and say the price of taxis has gone up because they've got a quarter of the market and they're charging more. But
Well,
I can,
I'm going to contradict you actually, and
I'm
I'll
sure you
argue the
are.
other point because I'm going to say they're probably gone down. So I think the Waymo is a new service, and actually, like for like, I'd suspect that Uber. So you'd have to measure what Uber prices have done. And I think you added capacity to the market, and Uber prices have likely gone down. And I'd be looking at Uber prices, and I'd be applying that the bane of this podcast, hedonic adjustments to the Waymo prices, and saying that actually it's a new service, not comparable. Comparable prices in the form of Uber and Lyft have gone down.
And do we have an answer? Do we know how that it's being dealt with?
No, we don't.
No.
Actually, that's a good point. But we don't have an answer, but just a philosophical,
Right.
discussion. So bottom line, I thought this was really interesting because I was thinking that, the impact of new technology would be deflationary, but actually consumers seem willing to pay for new services, pay up for them. So they might not be. And on to AI, Stuart.
Right. Let's see if we can get through this one. It's very interesting. This is all data or based on data from MacroStrategy Partners. And it's really looking at the economics of AI and AI data centers. And I think the interesting thing here is in a sense, the bottom up, the unit economics that they've looked at rather than the hype and the possibilities. So just going through the maths, so bear with us. So the cost of an NVIDIA Hopper chip fully installed in a data center is about $50,000. It's got an expected lifespan of only 18 months before the next chip comes along. So if you think the cost of capital is, say, 10%, and you require a return of 15% a year, and you build in a bit of margin of safety, then the required hourly rate to rent out the use of the Hopper chip, we go through the maths here, 50 grand times 1.15 times a buffer of 1.15, well, anyway, this works out that you need to be charging $5.78 per hour for use of that chip if you're going to make your 15% rate of return. And that would assume that it's rented out 100% of the time. So if you need $5.78, well, how much are you actually getting? Well, it does rather look as if you can rent a Hopper chip for much less. So MacroStrategy Partners, they think that they found prices of less than $1 an hour and that the price range is between $1 and $3. So that's, even at best, that's half of the required cost to earn a sensible rate of return on the Hopper chip. So it would seem that AI data centers are not a particularly good investment. So the economics of the next chip, the Blackwell chip, is even worse. The Lambda Labs rents out Blackwell chips for just $3.80 an hour. And this is a chip that has twice the computing power of the H100. So why would you rent a Blackwell when you could rent out just two of the Hopper chips for $1.98? So MacroStrategy Partners estimates that at $3.80 an hour, a data center will lose half the value of its investment in the Blackwell chips, and possibly more because we know from the DeepSeek experience that the training time for the LLMs doesn't have to always go up, up, and up. There's also a technical point that the heat output of the Blackwell chip raises the danger of burnout. So this is just trying to look at this as a simple business, unit economics, and it appears to be only raising roughly half the revenue that they require. CoreWeave, which is a big AI data center, which has just recently floated on the market, had quite a difficult float, and it bobbled along for a month or so. But recently, it's gone, almost to the moon. So it's gone from less than $50 a share to $170. It's seemingly bizarre because there were a lot of doubts about the economics of the business model as it floated, and we haven't had new data to really disprove that.
Yeah, that's in 3 months.
Mm. Then there's the whole issue, as you often see in new industries, of there's elements of it's not exactly self-dealing, but there are incestuous relationships between CoreWeave and its backers. Now, I won't go through all the details on this chart, but NVIDIA, for instance, they buy CoreWeave buys a whole load of GPUs from NVIDIA, and NVIDIA agrees to spend money renting back the use of its own chips. And
Yeah.
NVIDIA has invested directly in CoreWeave equity. So there's a sort of vendor financing thing going on, which makes everything somewhat smelly.
Yeah. And the bottom line is, though, that CoreWeave's revenues, like its revenues in Q1, 982 million, its market cap is 82 billion,
Mm.
and it lost 315 million. It's that's a big valuation to put on a company that currently loses $1 for every three it takes in.
Yeah, well, again, it's this issue that the technology may be great, the technology may be useful, but that doesn't mean that you're necessarily going to make money out of the companies providing it. Right. So one issue here, of course, is how long are the chips going to be used? And the argument has always been that the longer you do the training models, the longer the test time compute is, then the better the model will be. And so therefore, you do have to keep using more and more chips. And we have these charts from OpenAI, which compare test time with a measure of accuracy. And I think you point out, Keith, here that the important point here is the x-axis, the test time is on a log scale. So the point is you need to be throwing more and more and more compute to get incremental changes in accuracy. However, other researchers have started looking at problem-solving abilities of the LLMs and how they change with the compute time. So here, the outcomes are much less encouraging. So the logarithmic x-axis implies that linear gains in the computing accuracy results require an exponential increase in computing time. Now you could represent that as say that there's a sort of boundary on accuracy, and you would have to massively increase compute to get very fractional increases in the accuracy of the LLMs.
Absolutely. So there's a limit to how good LLMs are, and you need to put in exponential increases in training time to get small increases in their accuracy.
And it's worse than that because individual LLMs may improve with the length of their training time, but actually overall there's very little correlation between the accuracy of the LLMs and how much it costs to train them. You see here a measure of accuracy and a measure of cost, and there's very little relationship between them. And in particular, the blue bars in the center are DeepSeek, showing very small costs. We know there's obviously a lot of opaqueness to exactly what they did and at what point in the process they jumped in and what they piggybacked on. But this does raise serious questions about how much you can improve the LLMs just by throwing more compute at it.
Yeah, and I think the important one is this one, ChatGPT 4.5, which is very expensive to train and actually not as good as DeepSeek, which cost much less.
This result I thought was rather fun. This is IQ test results applying to the different models that are out there. And you can see OpenAI's O3 being scoring on this IQ test about 115. And there's a whole range of models scoring less than 100. Interestingly, including Llama, which appears to be, way off the pace, which is why Zuckerberg apparently is offering $100 million signing bonuses for AI scientists.
Wow.
So if you rank by test score, it's very clear OpenAI is at the top at the moment, but Claude 4 Opus is also well up there. And this is uh, some results by Mensa from Norway. And I think we're used to thinking of 100 as being about average IQ, aren't we?
Mm,
And we're now getting
yeah.
OpenAI O3 at about 133. But I did a little bit of digging on this, and that there's a real risk of a little knowledge being a dangerous thing. But that there do seem to be a bit of a step change in how the models are being built with this reinforcement learning, where the models stop themselves going off track. I think the press has been full of stories of the standard LLM models that we're used to, like the initial chat GPT, where errors sort of compound up, and
Mm,
when the model goes beyond the area that it was trained on, it comes up with just craziness. And these more recent models with this reinforcement learning, they go back on themselves and sort of check themselves, and
mm.
it brings them back sort of onto the straight and narrow, as it were. And I don't know if you've seen this, Keith, but when I've used some of the models and it goes through, you can see it thinking and processing. It'll say, wait, but I said something opposite before. I'll go back and check. You,
Oh, right.
you can see a sort of recursive aspect to it as it's trying to check itself. And even if you only do that 3 or 4 times, you can
Mm.
squeeze out quite a bit of the errors and have that self-checking going on. Right, sorry. IQ test scores over time. This is DeepSeek on 2 different tests, not in a way really showing much uptrend in performance. But I think that this is an example of an initial LLM model and not these reinforcement ones.
Yeah, but you you'd expect them. They're always learning these LLMs. You think they're being trained on ever vaster data sets, but they're actually not improving in their IQ.
Well, I think if you look at some of the OpenAI ones, then you can see each release is getting more of a step change up. I don't know if you can flick back a slide.
Yes, no, that's true. But you need a new release. You need a change in the code. The
Yes.
actual models themselves are not improving.
Well, I think we need to research more, because my understanding is this reinforcement learning process in the new model is what's
Right.
pushing on the improvements. Right, so this is GPT-4, the Omni version. Again, yeah, not showing any improvement over time. So there is a skeptic's perspective, and I think Emily Bender, she was being interviewed, I think, in the FT this weekend, wasn't she?
Mm.
And she said that AI is, despite the hype, pretty bad at most tasks, and even the best systems available today lack anything that could be called real intelligence. She came up with a famous phrase that they are just stochastic parrots. And that is a system for haphazardly stitching together sequences of linguistic forms that it has observed in its vast training data, according to probabilistic information about how they combine, but without any reference to meaning or understanding, which I sort of, I can sort of sense what she means, that they're just predicting the next token, aren't they? They're predicting the next word. And yet when you use them and you begin to see this sort of recursive reinforcement learning, I think that they are pushing beyond uh, just a statistical association.
I'm not at all sure, Stuart, because there's no intelligence there. I don't think they're understanding the problem. It's just based on relationships they have observed as opposed to actually understanding what you're asking. what they're saying is people who've asked this before tend to get this answer, so this is the answer.
Yeah, yeah. It's not an understanding of the underlying concept.
Yeah.
But I must say,
Mm,
I have found them very useful, but you have to be alert. I got it to do a forecast of my UK tax liability, and I had to say, no, look, you've got that bit wrong, you've got that bit wrong, and it would go back and recalculate it. It seemed to understand the implications of the error that it had made, and it was voluntarily going back and redoing things.
mm. Well, I also liked her other point, which was that skeptics tended to be drowned out by the big AI companies who have vast resources and a lot of people who have vested interest in AI being success, just drowning out all the skeptics who tend, have less skin in the game and tend to be, academics with a deep understanding of this.
Well, I think Sam Altman's response was, they may be a stochastic parrot, but so am I, and so are you. Perhaps that actually is what intelligence is.
Mm. No, I
Hmm.
disagree. I disagree. I think you need to under when we're asked, let's say, a maths question, you understand the basic concepts. So if they ask you a different question, you can come up with the appropriate answer. Whereas LLMs, I don't know how they deal with maths. I hear they deal quite well, but you're based on her description of them would be that they're just working on associations from what they've seen in their training database.
Well, I think we need to do more research to understand if there's a more step-by-step checking process that they can evolve into.
Mm.
Right. Well, adding to the skeptic view is the Australian government, and they've done a trial that found that AA is much worse than humans, as summarizing. Um, And in particular, well, I think we've all come across the very confident hallucinations that they all come up with. And I think we've also seen many stories of gradually evolving around giving users what the users want to hear. And
Yes.
you've heard of sort of fake relationships that develop. So AI appears to be useful only when a good approximation will do, rather than absolute accuracy is required. So translation could be a good example. Um, my goodness, is this a real example where
Yes, it is.
AI hallucinated that it was Airbus, not Boeing, that was involved in the fatal India air crash? So again, you could see your point that all it's doing is a sort of word association, a word probability
Yes.
exercise.
Yeah. And that was Google's AI model.
So bottom line, where are all the AI devices? I see that Apple is being sued for securities fraud for not developing its AI device as it had promised it would do.
Well, that was very interesting actually, because Macro Strategy Partners was saying they did develop it, but the results were not good enough. So,
Ah,
so
right.
Apple, pride themselves on very high quality consumer products, and it was just hallucinating, and they didn't think it was good enough quality. But they have been spending a lot of money on it, but they chose not to release it, which
Right.
makes sense to me.
So LLMs are proving to be of limited use in many real-world applications, particularly where total accuracy is required. However, NVIDIA is continuing to sell vast numbers of chips, but as the economies of scale are perhaps illusory, that growth would seem likely to peak and then fall. So there's a real risk that the AI bubble is nigh.
Yeah. So I mean, what this segment was all about was continued investment in vast numbers of AI chips is based on the premise that in order to train the better AI models, you need to spend increasingly, exponentially increasing amounts of time training them, which means you need vast numbers of chips. But actually, DeepSeek's proved that isn't the case. And actually, ChatGPT 4.5 proves that isn't the case because you got a worse result. So at some stage, people might stop buying vast quantities of new chips and concentrate on refining their models on older, cheaper ones, just like DeepSeek did. And related to that, thank you, Stuart, let's talk about the data center demand, electricity demand. So, like it or not, people are developing huge numbers of data centers. So this is data centers announced since 1st of January 2023. These are big numbers. 30,000 megawatts in Texas alone, throughout the US. Data centers are hugely power hungry, and that is actually going to change the trajectory of US electricity demand. I mean, it had previously been stalling, but now it's forecast to start rising again, which means you're going to need a lot more electricity generation. Now, previously, coal had been displaced from the energy mix to be replaced by gas and renewables. And actually, in 2025, coal and natural gas consumption as part of the for electricity generation fell because there was huge amounts of solar. So the yellow bars are solar. Lots of investment in solar power generation. But starting in 2026, you're going to see gas coming back into the electricity mix. So natural gas is forecast to remain about 40% of an expanding electricity generation market. So more demand for natural gas. At the same time, as we've talked about many times, the US is developing lots of LNG liquefaction trains to increase its LNG exports to, amongst other places, Europe. So that adds to demand for US gas. So we've got increased demand for natural gas from electricity generation and increased LNG demand. So the natural gas market in the US is tightening, and the EIA forecasts that will translate to rising US natural gas prices, and the numbers aren't trivial. So they are forecasting that US natural gas prices will rise from about $3 now to $5 within the next 18 months. So that is a 60% rise. And it comes at a time when shale gas production is starting to top out. So what you've seen is this absolutely enormous supply shock from US shale, which after a dozen years is starting to slow. And when you look at total US gas production, it is also stalling. Now, US natural gas prices, when you look at them over the last 20 years, you can see the effect of that supply shock from US shale. They are well down from the pre-shale period where they averaged, was that $7? Bear in mind, inflation has gone up a lot since then, and they're now at $3.80. So, over that period, prices have gone up, natural gas prices have come down. So the EIA is forecasting that US natural gas production will rise by 2.7 billion cubic feet per day in 2025, but it will slow next year. And electricity prices will keep on rising. So all this adds up to a bull case for both US electricity prices and US natural gas prices. And in particular, natural gas demand is increasing at a time when, well, until the US bombed Iran, oil prices were quite weak. And a lot of US natural gas is as a byproduct of oil drilling in the Permian. And as we showed you earlier when we were talking about oil, rigs are coming out of the Permian, which means that in a year's time there will be fewer wells drilled, which will mean there's less byproduct gas. So it seems that the US natural gas market may be tightening. So that should be good for US natural gas producers, electricity producers, including solar, US utilities, and electricity infrastructure companies. If anyone has any particular bull ideas, I would love to hear them.
Well, Keith, I do have a little one.
Go on.
It's at the lower risk end of what you're talking about here, but there is an ETF listed in London. The stock code is PMLP, which is basically a collection of the gas transportation companies. It's all infrastructure stuff.
Right.
The point is that they extract a toll for moving the gas and the oil. They're not particularly linked to the oil or onto energy prices. It's all really about volumes. So they are sort of like toll businesses, and they earn a decent return, which is typically semi-indexed. So it's quite a good sort of growth bond, if you want to look at it that way.
Interesting. So I also have one, which is DEC, Diversify Energy, which I have owned disastrously for years, but it's basically a scavenger which buys old gas wells and as, gets the last puff out of the cigar butt, if you know what I mean.
Yeah.
And rising gas prices will be very good for it. So anyway, if you're interested in this, there's lots of discussion on the Discord channel. And actually, so last section this week, let's talk about the UK home builder Vistry. Now, in the spending review, the Chancellor Rachel Reeves announced 39 billion in the coming decade for the Affordable Homes Programme, which provides grant funding to local authorities and housing associations to build affordable homes. And as with all political announcements, it's actually less generous than the headline would suggest. So this is the annual investment in affordable homes. You can see the 2025 number is higher than the average for the last 5 years, but not much so. Apparently the money is back-loaded, so you get more money later in the Parliament. But there's one house builder in particular that stands to benefit, and that is Vistry. It was formed in 2022 from the merger of traditional house builder Bovis Homes and Countryside, which specialises in partnerships. Now, what's a partnership? Well, before we get into this, this is the structure of the UK house building market. So your traditional house builders, and their term speculative builders, about 60% of the market. Affordable homes, and that's the partnership model, is actually much larger than I thought it was. That's almost 30%. Self-build about 7%, and then build to rent about 5%. Now, so what is the traditional, i.e. speculative house building model? That's 60% of the market. Well, so you buy land well in advance of development. You then shepherd that land through the planning process, which in the UK takes years. And then you slowly develop that land and you drip feed new houses onto the market to ensure that you don't affect prices. And then construction is outsourced to contractors. So that is the traditional house building model. The partnership model is you collaborate with housing associations, local authorities, and the private sector rental and the private rental sector to deliver affordable houses, buy to rent, and you stick in some private for sale units that you have developed in the same development. So the details will vary from project to project, but so either the developer will own the land and partner to get it developed, or the partner will approach the house builder with land it already has to get that developed. The important point is the partner, so the housing association or local authority, will pay for the development, the construction of the houses up front. So the house builder is not using its own capital to build the houses. And the house builder may add its own for sale units within the development. So this is sort of the mix you'd expect to see on a typical Vistry partnership development. So 50 to 60% of the home construction will be funded by the partner, and then the remainder will be developed by Vistry, a speculative construction. Now, what are the advantages of the partnerships model? Well, the main advantage is your much higher return on capital. You are using the housing association's capital to build the houses, not your own capital. So you require a lot less capital. So any profit is divided by much less capital in the business, and you have a much higher return on capital employed. You also have much better earnings visibility because you've been paid upfront to build the houses rather than building them and then attempting to sell them, drip feed them into the market. And as you will all know, that when you go and see one of these housing developments, it can take years before the final units to be sold. And that also equates to much lower cyclicality. The housing associations get steady funding from the government, and they build a certain number of houses each year, so you're not dependent on the traditional housing cycle. So if we go through the economics of a traditional building site, a traditional house builder, let's say they build a plot of land for 50k, and they then need to get that through the planning process. That takes, let's say, 3 years, and frankly I think that's an underestimate, and that will also cost a lot of money, let's say another 50 grand. And then once they've got permission, they will develop the land slowly. So let's say the plot we're talking about is undeveloped for 2 years, as you develop all the plots around it in order to drip feed houses onto the market so as not to affect prices. And then finally you construct the house, which takes a year and costs 150 grand up front. And then finally you sell the house for 350k. Now when you look at the costs, it has cost you 250k and you've made 350k. So you've made a 40% gross margin, which looks great, but it's also taken you 6 years to make that money. So your return on capital is a not very impressive 13%. Now, if you look at a partnership model and look at the same development, the construction is paid for 18 months before completion. And so your sale price is also lower. So the housing association is going to demand a below market price because it's affordable housing, but your return on capital rises to 18% because you're not using your own capital. You're being paid to develop the house, despite the fact you're getting a lower price for the house. Also, houses don't need to be drip fed into the market. They are prepaid and so can be developed at any time. They have a ready market, and so your development time can be cut by 2 years. But the flip side of that is that you're attempting to develop all the houses on the same site at the same time, which means your construction period is going to be longer. Let's say it increases from 12 to 18 months. And because it's taking you 2 years less to develop these houses, that means that housing inflation over the period the house is being developed is less. So let's say the sale price falls from 315 to 305. Despite all that, because you're not using your own capital and your development time is shorter, that means your return on capital has risen to 29%, and it gets better. The land is usually provided pre-permissioned by the partner. That's the point of having a housing association. So if you then add an extra house to the development and the partner pays for that construction, well, that massively increases the return on capital. And so if the partner pays 175 grand for a house that still costs 150 grand to develop, then your return on capital rises to 49%, i.e. much, much better than a traditional house builder. So bottom line, the partnership model allows houses to be built with the partner's capital rather than Vistry's, and it therefore requires much less capital, and your return on capital employed is much better. So Vistry has two arms. It has Bovis Homes, which is a traditional house builder, and it has Countrywide. And so it is closing down Bovis Homes and returning 800 million of capital to shareholders. And going forward, it will concentrate on the partnership model, and it is targeting 40% return on capital by 2028. Traditional house builders have return on capital of 10 to 18%. So medium-term targets for Vistry are return of capital employed of 40%, revenue growth of 5 to 8% a year, operating profit of 800 million with a 12% plus operating margin, and is going to return all the excess capital from slowly winding down Bovis Homes and its traditional house builder. And so it was targeting returning 1 billion of capital to shareholders. Now that's down to 800 million, having returned some already. And in the US, the analogy is with the house builder NVR, which pursued this model and has generated return on equity of 20 to 40% per annum and used its excess profits to buy back shares. And so its share price has gone up 70 times from its lows. So Vistry are attempting to be a British NVR, and with that in mind, in May 2023, they appointed as a non-executive director Paul Wetzel, who had been a non-exec at NVR for 10 years. But that's the plan. It ain't going so well, frankly. So the plan was announced here. Market initially really liked it and the shares went up, but then there were a series of profits warnings which were all related to the traditional house building sector of Vistry. So in October 2024, it issued its first profits warning and stated that adjusted profits would be around 350 million, down from 430, all due to its southern division, which it stated was the only division which was run entirely by people from the traditional speculative house building division. But then again in November, it had a second follow-up profits warning, reducing its profits guidance further to 300. And then in December, a third one, reducing its profits guidance to 250. The market did not take this well. The share price plummeted by 60%. There has been they've commissioned a third-party independent review, and that has been quite reassuring and saying that the problems are not systemic. So, in summary, this has been a brief overview of the story. There's lots, if you join the Discord, there's lots of discussion of this, and I will try and post links to some blogs which go through the Vistry story in much more detail. This is an outline of the investment case. And the investment case is the Vistry stands to benefit from the UK Affordable Homes Programme. It is moving to a capital light partnership model, which will see it return capital and increase its return on capital employed. But its current share price has cratered because of a series of profits warnings relating to Bovis Homes, which is a legacy business and which is winding down and it is returning capital to shareholders. So hopefully the market has overreacted to profits warnings related to a division which is being wound down. And once it transitions to the new partnership model and executes, it will have performance similar to NVR, is the theory. So my thoughts are, I like this story, but it is not a story which will play out over the next weeks or months. This will play out over years. So if Vistry manages to execute on its strategic tilt to being a partnership model, then it will start buying back shares and the market will then re-rate the shares as it gains confidence in the model. And in the case of NVR, you'll see that it went up 70-fold over 2 decades. So there's no urgency to get in. But as the story starts to get traction, then you could see the shares going up a lot as basically excess cash. The thing is, a capital light model only requires a certain amount of capital because you can't keep on. There's not enough capacity in the business to use all the profits, and so those excess profits are returned to shareholders through share buybacks. But warning, the returns on Vistry are very unlikely to be anywhere near as good as NVR because NVR is an American company and the housing sector there is much less regulated than it is in the UK. So what I've done is I bought a small position and I'm waiting to see if Vistry can gain traction. But I think this is a good asymmetric investment in that the shares are depressed because of the recent profits warnings, and so I see little downside, but I see lots of potential upside. Stuart, your thoughts?
So just to understand the business model further, are they acting as a sort of general contractor and they subcontract out the actual construction, or do they have their own, like teams and employees and are they actually the boots on the ground themselves?
Well, that's a good question. My understanding is all house builders largely outsource the construction to subcontractors. So they try and minimize their payroll and they have subcontractors they work with. So I would assume, and this is an assumption, and people please correct me, that they will be acting sort of as the coordinators and getting subcontractors they have previously worked with, etc., to do all the work.
And do you have a sense of whether the housing associations have got enough budget to really be ramping up what they can commission? I got the sense that they were somewhat sort of snowed under and that they hadn't their own financial performance wasn't strong enough to be commissioning more buildings.
Well, the thing is, the government is trying to push more money into this sector. And also, they were talking about making the British Building Bank, I thought, is that its name? An arm of government so that it could borrow at government interest rates and which would mean that it would find it cheaper to raise financing for affordable homes. So I mean, the point is that even if I'm wrong, Stuart, and let's say housing associations do not find it easier to raise money, and government policy is obviously that they will do, but if they don't, still, Vistry are going to move to this capital light model whereby you close down the traditional house builder, return a lot of capital, and then you have a smaller business which uses less capital and kicks off a lot of cash in form of share buybacks. That still sounds pretty good.
Hmm. Well, I do
And
like the idea of a management that has clearly got a sort of cash flow return on investment um, metric rather than traditional earnings growth, etc. It's obviously what most investors are really looking for, and finding managements that have genuinely got it as their lodestar is quite tricky.
yeah, and I think, we're rather than trying to second guess them, I mean, the management is very experienced. And so when they're forecasting, operating profit of 800 million with a 12% plus operating margin, revenue growth of 5 to 8%, return on capital. I mean, this may be aspirations, but there must be some facts behind this, some reason behind this. So, if they can actually execute, this looks a good story. And, if they can just stabilize the business after a series of profits warnings, you'd hope it'd re-rate.
Well, I'm going to do a bit of research. It does sound quite an interesting bet. And if the problems are just limited to that old Bovis division, then hopefully they're cauterized, that
Yes.
the extent of the loss is known. And then, as you say, it's hopefully fairly asymmetric.
Yeah. So, it's towards its lows of the past few years after the series of profits warnings. If you can gain traction, you can see the market liked the story, but they didn't like the profits warning. So, there you are hoping that, well, calculating that they are going to be able to execute on this plan. But its shares rose when Bellway reported quite good results last week and have since fallen back a bit. But, I see if they can just stabilize the business, you can see it going back to the price it was before the profits warnings. So I think this is a good asymmetric bet, frankly. And I will be adding to the position in the next, over the next few months. Now, we're not going to have time to do this, but thank you very much to our viewer, Terry Smith 8092 on YouTube. I promise I'll do this um, discussion about oil demand next episode. In the meantime, on to Inflation Watch, Stuart.
Right. Well, I think to my mind, the core CPI is what we should be looking at. UK about 3.5. Um, Japan also about 3.5. US and Europe 2.8 and 2.3. So yeah, some inflation pressures, but equally we've got signs of emerging economic weakness. So central banks sort of squeezed in the middle. China still deflation.
Yeah. Well, any thoughts about Japan, Stuart? You know a lot about Japan.
They're in a horrible position. They're being completely squeezed. A very unhappy population, which is finally having to face up to the massive debt load, and now perhaps the brakes coming off long bond yields. So I think that there's a car crash in the offing.
Mm. Oh,
Yeah.
you
This
go.
is Japan core inflation. I mean, look at this. A few years ago, we had no conception of inflation in Japan, and look at that. If you're having wage increases of 1 or 2%, you're being squeezed year after year.
Yeah. Well, what's astonishing, and we've talked about this on the podcast for years, is that, this is kind of slow motion harakiri in that we said if they were going to get inflation up to 2%, then they'd lose control of government bond yields. And that's exactly what's happened. And
Beginning to happen, isn't it?
given
Yeah.
the debt burden, they can't afford to do it. So, it's weird. And actually onto recession watch, because I've been meaning to do this for a few weeks, and there's just been so much going on in the world, I haven't had a chance. So we're going to quickly go through this. But so recessions tend to start when monthly non-farm payrolls are below 100K. And we are now at around 140, moving slowly towards the critical area. So be warned, the labour market appears to be slowing. US consumers are cutting their credit card debt in the face of record credit card interest rates, and we've seen that in the UK. Credit card interest rates have hit a new all-time high. The problems in office real estate have not gone away. So office commercial-backed securities delinquency rate is right up at its levels in the post-GFC. The Conference Board Consumer Conference Labour differential is deteriorating once again. So the blue line is the labour differential. That is number of consumers who say jobs are easy to find minus the number who are saying it is harder to find. And a rising number means that it's harder to find a job. And US households are perceiving that their finances are deteriorating. So more people are saying they're somewhat worse off than, and fewer people are saying they're better off. Now, seeing that retail sales in the US are falling, consumer confidence in their finances are declining. Are the two related? You would think they're probably likely to be. And when we look at delinquency rates, you'll see they are rising quite sharply, particularly amongst the young people. Now, the reason for that is actually student loans. So the moratorium on student loan repayments has ended, and so everyone has become liable again for their student loan debt, and it's leapt right back. The delinquency rates have leapt right back up. So particularly for old people, actually 50 plus. And so the rise in delinquency rates you see here has almost entirely been due to student loans. The other delinquencies are actually fairly stable or elevated, but not rising anymore. And the New York Fed is reporting that delinquency rates on all loans are rising. So mortgage delinquency rising, auto loans, credit cards, all signs of consumer financial stress. And if you ask the US population whether they can afford to pay a $2,000 emergency bill, well, an astonishing number of them say they are really going to struggle. So what's that? 52% say they'd struggle to afford it. And bankruptcy filings are higher than they have been at this time of year since 2010. Construction spending, this is a big thing, actually. We've talked about construction, but construction spending year on year is negative for the first time in a few years, and this traditionally is a big harbinger of recession. Residential construction declining, and newly completed homes rising. So there are lots of new supply coming onto the market. And that means that the housing market is very well supplied, and house builders are not inclined to keep adding to it. There are more sellers than buyers, all adding up to evidence that the US housing market is weakening and house prices have started to fall. And it's surprising how infrequently house prices have fallen month on month in the last, what's that, decade. Only briefly post-COVID after an enormous surge in house prices. So that's quite interesting. Falling house prices are a rare event in the US. And 61% of US counties are now experiencing declining house prices. So that's all adding up to the US housing market definitely slowing. US restaurant sales showed a sharp drop in April, and JP Morgan are forecasting the US will suffer a technical recession in Q2, and sorry, in H2 2025. So I don't think anyone else is forecasting such a sharp slowdown. It looks like the US economy is weakening. And although there's little sign of a recession yet in the data, there's definitely signs of a softening. And onto other charts, Stuart.
Right. Americans are seeking more help with adulting. Goodness, I can relate to this. I often get texts from my daughter saying, "Oh, how do I do X? How do I do Y?" My goodness, but people apparently need to be told how to use a mop, and that is a bit scary, isn't it?
I know how to use a credit card.
How to use a hammer. Can this be real?
Well, do you believe what you see on the internet? There's people have gone onto this is data from Google. It's like
Well,
what you don't know is how many people these are. It could be like 100. It goes from naught to 100. I mean, it's like, does that represent 100 people in the whole of the US? But still, it doesn't really inspire you with the what's it called, Gen Z.
First time home buyers in the US are older than ever, up to 38. Yep, it's expensive and pressure on all forms of income and expenditure. I think we're seeing a lot of this in the UK as well, aren't we? And it filters over into, child rearing. If you can't afford a house till later, you can't afford to bring up a kid.
Well, I thought the repeat buyers number was just astonishing. 61. That's just mind blowing. Oh, nobody, you don't move house over the age of 60, I thought. But, anyway.
Well, talking of the housing market, this is mortgage payments as a share of the median family income. So for first-time buyers, I mean, it has been higher in the early 80s, but it's pretty painful at between 35-40% of median family income compared to all buyers with much more affordable 25%. So the noose is tightening there as well. The share of household wealth held by Americans who are over 70 has been on a remorseless rise. It's now 31% of wealth is held by the elderly. I guess
Yeah.
then the question will be, does it get inherited or does it get spent on elderly care?
Yeah. Good question.
Oh, right. This is a compound interest question. Have we got? Okay,
Yeah.
so Investor one starts at age 25, puts 5 grand a year away for 10 years, and then does nothing else. Investor two doesn't start at 25, they start at age 35. They invest 5 grand, but for every year for the next 30 years in a row, whereas investor one had only done it for 10 years. Who's got more at the end? Well, we can tell by being asked, can't we? But that is pretty phenomenal, isn't it?
It is, yeah. Start investing early. So, I said before, what I do for the kids is we put aside, we give them each 200 quid a month, which the government tops up to 240.
Mm.
And, it's a good way of transferring money to your kids. Um, and they won't be able to access it, obviously, until they're 55. But by that stage, it will compound it a lot, frankly.
That is, yeah, phenomenal. I wouldn't have guessed that. I mean, we all know the power of compounding, but my
Yeah.
goodness. So
Yeah.
it's just 10 years and then stopping produces more than 30 years in a row if you start 10 years later.
Yeah.
Solar panels are less efficient as their temperature rises. Hence, the relatively low solar radiation at higher latitudes is a little bit offset by their higher efficiency. Well, how about that? So
Yeah.
this is where temperatures, so if you're setting up a solar panel farm in Saudi Arabia or something, you're actually going to have a bit of power loss if they're out there at 35, 40, 45 degrees. Hmm.
Yeah. No, I've stuck this in because I just found it was really interesting. So, on the hot summer's day, you'd hope that this carried on rising because, you're getting lots of radiation. You'd have a linear relationship. You don't. Actually, the rise in heat means that it becomes less efficient. sadly. Okay, and finally, on to good news. Now, this is a picture of the penny hang in England in the 19th century. So, you know, if you didn't have a home to go to, you could go down to the cellar and just like lean over a rope for the evening for a penny. And, whenever we talk about, the state of the nation, we we kind of romanticize the past, frankly. Yeah, this is how life used to be.
But Keith, you know what this is the origin of?
Gone.
The phrase hungover.
Oh, right. Yes, of course. Very good. Yes. So, concluding comments. Well, it seems to change every time. World seems to change every time we do a podcast, frankly. And so much of what's happening in the world depends on the news at the moment, where there's not where everything is related to Donald Trump, but a lot now depends on how Iran responds to the attacks. Will it attempt to close the Straits of Hormuz or respond by attacking Qatari or Saudi oil infrastructure? If it does, then oil prices will rise sharply. And that would be good for oil and energy equities, but bad for pretty much everything else, apart from short-dated government bonds. So we're hostages to the news at the moment. Watch this space. Stuart, have you got anything you want to discuss about your portfolio? How you?
Just as I'm very much as I was before. I've got reasonable equity exposure, but it's world X US because I just can't get over the US equity valuations. And within world X US, I've got a couple of investment trusts that specialize in picking medium and small Japanese companies that are under pressure to improve their capital returns, and that they've been quite successful. I've had a couple of forced exits where a couple of preference shares that I owned were forcibly rebought back,
Right.
making a nice profit. But then I had the problem of reinvestment, and I actually put a good chunk into gold, even at these levels, as I worry about debt, etc. And
Yeah.
I've topped up a little bit of my income exposures via REITs, green infrastructure, and regular infrastructure. So no great changes, but just a few tweaks.
Well, it's been a very long episode, but actually there are a few things I wanted to talk about. So, talked previously about my positions in REITs, and frankly, they keep on getting taken out, which is both good, as Stuart's talking about his preference shares, but also a total pain because, I bought them for the income, and actually the number of REITs which are, yielding very well is increasingly dwindling as they all get taken out. So this was it yesterday or the day before? Downing Renewables taken over at 102.5. It's the price of the market is now 101, and I've made a 20% plus return. Um, and I had a big position in this because it was yielding very well. So what am I going to do with the money? Well, on the Discord, we've actually been discussing what will get taken over next. And the takeover targets tend to be, medium-sized REITs, which are digestible to private equity. If they're like 1 billion or 2 billion, they're not going to be taken over. If they're around 400 million, then they're digestible. So Octopus Renewables next. I've been putting a bit of money into that, 26% discount to NAV. Foresight, I like, as you're yielding almost 10%. I literally bought it at the low, so I'm already up. Discount to NAV 26%, 498 million market cap might be in the targets of private equity. Now, this is an interesting one. This is a total catastrophe. Digital 9 infrastructure. And its NAV is 34p. The share price, the market has totally lost confidence in it. It's currently trading at about 9.3p. But I've read various analyses. And it seems that the NAV, the new managers come in and has basically kitchen sinked it. And the NAV itself seems quite conservative. It's in wind down. If they can realize anywhere close to NAV, you're going to get a multiple return. I think, it's worth having a little punt on this, I would have thought. So I'm taking a look at that. Cordiant Digital, we've talked about previously. It's doing very well, results recently. Dividend yield only 4.4%, but well covered, and the NAV is growing, unlike a lot of infrastructure trusts. And I have a big and growing position in this. This is SDCL Energy Infrastructure Trust. It's a dividend yield of 12.3%, even after this sharp rise. It was at 43p at its lows. Discount to NAV at 43%, and results were out yesterday, and they seem okay. Yes, actually, no, was it this morning though? And results seem okay. Dividend cover this year 1, but next year 1.1. And when it's at a discount to NAV of 43%, then you have a very good margin of safety. So that's it. Super long episode. I apologize for that, but lots of interesting stuff to talk about. Thank you very much to Stuart Owen for subbing in Richard's absence. And reminder, next one will be in a couple of weeks' time, but not on the Monday because I need to catch up after my week in Dolomites. But in the meantime, thank you very much for watching. Please can you press subscribe and whatever, everything else. And it's goodbye from Stuart Owen.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.